Hey everyone, after a huge rally for almost 14-15 months, Indian stock market is witnessing some sort of pullback and weakness. But it's very important to understand that such corrections and consolidation are very healthy for the market. Actually, after a one-way rally for 14-15 months, Indian stock market was trading at a good premium to its historical valuation. Especially the mid-cap and small-cap segment was quite overheated in terms of valuation. So this is a much needed cool down that would eventually create buying opportunity for long-term investors. So recently I've been tracking 3 microcap tech companies that are looking promising. Now first of all, let me clarify the risk involved in microcap stocks. The problem is that majority of people want to invest in microcap companies just because of high growth potential. But it's important to understand that microcap stocks are very volatile. One bad news and they can fall badly. So before investing your money, understand your risk appetite. Many people actually don't have a high risk appetite and they panic on even 20-30% correction. So keep this risk in mind that microcap stocks are volatile. And this video is not to say that go and buy these stocks immediately. The idea behind my video is to share my knowledge with you all, and I expect you to spend some time studying the company and then take a call whether you find that company promising or not. So no need to rush. First understand the business, their growth journey, and then build conviction. In case you are here just for stock tips, I'm sorry, this is not the right channel for you. This channel is only for long-term investors. By the way, if required, I can do a detailed analysis on these companies as well. So let me know. For now, let's have a quick look at these companies that I'm tracking closely. Alright, so the first company that I'm tracking very closely is All-E Technology. Company has a market cap of just 800 crore rupees. Now first question is, what is the business of this company? So basically, All-E Technology is involved in the digital transformation of enterprises. What does it include? So first of all, it includes the digital core modernization. One of the major business area of the company is to move the enterprises from on-premise to the cloud platform. Now, those of you who understand some bit of IT work, cloud is one of the most fastest growing segment within the IT industry. Okay, so this is one business area where All-E Technologies focus on. Apart from cloud computing, it is also involved in the automation of their enterprises application, then the modernization, then data engineering and AI. Then second aspect is these companies have certain applications like ERP, CRM, commerce applications. So All-E Technology here implement the enterprise applications as well as customize them as per the specific business need. Apart from this, it is also involved in process optimization, then system integration. So what happens is when an enterprise has got multiple systems and they don't interact together, that's where All-E Tech comes in and try to integrate those business and get insight out of it. And obviously when they do the integration, it involves a lot of data generation and AI analytics. So that's where it also add value. And then final part is change management. I hope you got a fair idea. The crux is that it is involved in the digital transformation of enterprises. The question is, how does it do? So for that, it leverages the entire full stack of Microsoft. Okay, so All-E Technology has partnered with Microsoft, and you all know that Microsoft is one of the biggest player in your enterprise application with products like Microsoft 365, Dynamics 365, data and AI, and then they've also got their Power Platform, and of course they've got their cloud platform, which is Microsoft Azure. So All-E Technology works with Microsoft, it implements their product. The question is, what is special about All-E Technology? So first of all, please understand that All-E Technology is Microsoft cloud service provider tier 1 company. So they have divided into tier 1 and tier 2. Tier 1 is the direct partner, tier 2 are mainly your indirect partner. All-E Technology is direct partner. It has been associated with 23 years with Microsoft. Company has got 360 around team strength, then more than 900 successful customers. And apart from this, I was going through company's con call to understand more about it. So one of the business segment, like I said, is implement the Microsoft product. Apart from this, company also has its own IP. Okay, and it does not compete with Azure, but it actually uses Azure platform and sit on top of that. And basically they build the industry solution, which is their own IP. And obviously this IP business would be more margin lucrative. Although currently this is a very small part of the business, around 10%. But still it is a separate business where they do their own application building. In addition to this, the company also work closely with Microsoft engineers. So it is not like, they are just implementing their product. They also work with their engineering team, and they work on new features, new functionality. They also do bug fixing, so testing, and so on and so forth. Apart from this, if you look at geographic spread of the company, 61% business come from US, 25% from India, and rest from Africa, APAC, and Europe. Then if you look at the leadership of company, Mr. Ajay Mian is the MD of the company, Rajiv Tyagi is the executive director. Just to give you a brief idea about the management, so Mr. Ajay Mian is the founding promoter. He has got PhD in physics from University of Delhi. So very interesting, this guy has got PhD in physics. That's not very common in IT industry. Then he spent a couple of years studying and teaching computer science, and later he founded this company. So that's his background. Then Mr. Rajiv Tyagi is the executive director. He is MSc in mathematical statistics from Lucknow University and MBA in finance from Indian Institute of Finance. So very interesting background. One is from PhD in physics and another is MSc in mathematical statistics. And I honestly really like this kind of diverse background. And of course, they've got a lot of experience in IT. He has got 25 years of experience across various domains within IT. So I found the leadership very experienced and has got the right knowledge as well to lead the company. Then moving on to the other parameters, which is the financials. So if you look at the top line growth, look at the growth in the business. It has been quite consistent, by the way. In March 20, it was 54, then grew to 61. It has grown to 70, 88, 116, and now 122 in trailing 12 months. So consistent growth. In fact, in last 4 years, the growth has been more than double in revenue. Next, if you look at the margins, margins have been also quite good at around, so ignore this, but yeah, it's around 16-17%. Recently, it is 18%. And if you look at the net profit, it has grown from 8 crore, which was around COVID period in 22, from there to 12, 2022. So a very good growth in net profit as well. Apart from this, if you look at other parameters like profitability, ROC is 23.9%, ROE is 17.9%, debt to equity is 0, so company is completely debt free. One very interesting point is company generates a lot of cash from operation. Look at this, CFO to EBITDA is 59.2%, which is excellent. And this is what I found very interesting, that in spite of having just 800 crore of market cap, company is sitting on cash equivalent of 115 crore. That shows the company's ability, and look at this, consistently generating cash from operation. Now, as far as valuation is concerned, kind of growth company is showing where it is growing at around 20, 25%, 30%. Commands a P of 36. That looks reasonable. It's not very expensive. If you just look at the share price movement, company was consolidating in last 1 year. It was at 200 levels, then it was at around 250 levels for a long time, and then recently it zoomed to 475. From there, there has been a decent correction at levels of 400. So at present, it is at 414. I think that kind of growth company showing at P of 38 looks reasonable. Again, I'm not saying that it cannot correct, but any correction, in my opinion, would make it even more attractive. Then if you look at some of the growth guidance, so management has said that they are expecting a growth of 25% from their business. In fact, what they are saying is this is all organic growth. Okay, so what they are saying is inorganic growth, which would happen eventually because they are sitting on good cash, so they will do certain acquisitions. So growth from inorganic acquisition would be additional. That's what I feel it's very, very promising. By the way, if you are someone who is not very sure about stock investment and looking for guidance, I also have a weekly video series where I share my own investment strategy, stocks where I'm investing my own money. And I also track more than 200 stocks. I've got an Excel tracker that I maintain. So every quarterly results I track, and that's it. But again, this is only for long-term investor who are really serious about wealth creation in the long term, not looking for tips. Okay, so this is one disclaimer, and you can explore this on my website. I'll provide the link in the pinned comment. Moving on to the next stock, that is your Ceinsys. Company has got a market cap of around 1150 crore. Now, what is the business of this company? So mainly two business. Predominantly, it is into your GIS. GIS, nothing but your geospatial services. Just think about it like this. For example, let's say government has got certain project where they want to do the mapping of land record. Right? That's where companies like Ceinsys adds value, and they provide their geospatial services. So that is just one use case. Apart from this, it is also into your technology solution. We'll come to that. Now, specifically within GIS, which is the major part of their business, it involved various segments. For example, company has been tracking 88,000 plus miles of electrical network. So it has processed those data and analyzed them. Then apart from this, within GIS, it is also into your water network, where it has covered 31,000 plus miles of network, and it has designed and implemented those network. Then it is also into your high resolution image data for business intelligence, right? So the point is that it does the digital tracking and recording of those data, which is very, very important. I think that there's a lot of potential for growth in the GIS segment, and that's where it is into. It's got 25 years of performance and more than 200 plus customers, 40% business from repeat customer. Apart from this, if you look at the business breakup, 81% business of the company is from geospatial and engineering service, 19% is from technology solution. So this technology solution is a recently added business where they acquired this company. So what happened is there was a lot of opportunity in GIS and as well as in your autonomous driving technology in mobility industry. And that's where Ceinsys took a strategic decision to foray into mobility service by acquisition of a company called Eligro Technology in FY22. And that's where this Eligro manufacturing, so it came into picture to get this technology solution vertical that spans around the entire product development process of, it is into your two-wheeler, three-wheeler, and covers the product engineering activity, industrial automation for various verticals such as, like I said, two-wheeler, three-wheeler, passenger car, commercial vehicle, and so on. So all in all, Ceinsys Tech is now a technology-driven organization that specializes in offering geospatial, enterprise, and engineering solution by providing independent opinion, actionable insight, and efficient solution to customer across private and government enterprise across your utility, infra, natural resource, and manufacturing sector. Now this slide gives a fair idea about their business breakup. So within water, you can see they have 35 plus treatment plant, 375 reservoirs serviced, more than 30 million population got impacted with this work that they've done. Water network they've mentioned. Likewise in energy, they have done 87,700 miles network mapping. Transportation also is there, where they've assessed road of 25,000 miles. Then other geospatial and AC work. Then in technology solution, company has got more than 4 million engineering product hours in automation and industry 4.0 solution. Then if you look at the geographical presence, 83% business is from domestic business and 17% from export. This is for geospatial, and technology is complete domestic. Now if you look at the management, let me just quickly share the details here on the website. So this is the management detail. You can go through their website. I'll just share some important names. For example, Mr. Prashant Kamant is a whole-time director, vice chairman, and chief executive officer at Ceinsys Tech. He was previously a CEO of Eligro and has got 28 years of experience, and he has done his master's degree in mechanical engineering from IIT Mumbai. So he started his career in 1994. So very good pedigree, as well as has got many years of experience. Apart from this, very strong leadership I found. You can go through the details. Let me not deep dive. If you look at the financials, company has been growing at a decent pace. Look at this, sales year on year, it has been growing from 57 crore all the way to 273 crore, consistent growth. Then margins have been also quite fair in the mid-teens of 14-15%. Again, there was some exception during 2020, it was 25%, again it fell down. So one thing I've noticed that the margins of the company are quite volatile. I need to track this company to understand whether these margins of 15, 16, 18% are sustainable or not. Although management has given the guidance that margins are actually going to increase over time. Then next, if you look at the net profit, it was on lower side before 2020. Again, it zoomed exponentially during 2020 and then fell down. So because of volatility in margin, but since last 2-3 years, there has been a consistent growth in number. So overall growth in number in last few years looking good. Again, profitability is good at ROCE of 22%, ROE of 16%. Again, virtually debt-free company. Again, generating a lot of cash, 80% CFO to EBITDA, which is again very positive. And if you look at the growth in terms of share price, company has been growing at a good rate. So in last 1 year, there's been a very good rate growth in the share price. Although if you look at the 5 year of journey, company was consolidating and correcting. So recently during 22-23 period, there has been a good jump in the share price. But the point is that in spite of this growth, company is trading at a PE of 30.7. So in my opinion, if this company, which management is guiding for 20 to 30% kind of growth and even expansion in margin, I think if that can happen at current levels, it can still continue to grow. So again, worth tracking this company at PE of 30 looks reasonable to me. So this is what I was talking about when management was asked about the guidance, that they have given a broad guidance of 20 to 30% kind of growth in the near future. Then third company that I've been tracking very closely is Unicommerce. This is a recently listed IPO, happened in August month only. Market cap is around 2,150 crore. Now what is the business of Unicommerce? So it provides end-to-end service to e-commerce companies. Now just think about it. Once you do an online purchase on e-commerce platform and the moment you get the order, so everything in between, when you place the order and when you get the order, everything in between that include your post-purchase, like your transaction management, order fulfillment, everything is taken care by Unicommerce. So it's a very unique business, very interesting business, and needless to say, a very high growth business. The business model of Unicommerce is such that it has a SaaS-based platform where it offers its services on subscription basis to all the enterprises that want to list their business on e-commerce business, where it helps them with the order fulfillment, transaction processing, and everything to do with the back-end work. And I believe that considering the exponential growth in e-commerce industry with the rise of D2C players, Unicommerce is very well positioned to benefit from this trend. And if you look at their business offering, their core product for transaction processing include your multi-channel order management system, warehouse and inventory management system, omni-channel retail management system, seller management panel for marketplaces, and then their order fulfillment layer include Uniship and Unireco, which is for shipping, tracking and return management, and payment reconciliation post-order delivery. Right? So this is how the business has been divided. If you look at their client list, again it includes some marquee names in the industry. For instance, fashion footwear accessories include Lenskart, Fab India, Bestseller, Hopscotch, then Bewkoof, Super Bottoms. Beauty, personal care, FMCG include Mama Earth, Wow, Sugar, and Plum, and so on. Then pharma, nutrition, lot of names, Farm Easy. Home and service, names like Cello, Urban Company. Electronics, you have got Boat. Brand aggregators, you've got companies like Goat, Iconic. Then international brands include Red Tag, and so on. So quite diversified. Company has got 855 enterprise clients and 2,770 small and medium business client. Moving on to their leadership, very strong leadership. Mr. Kapil Makhija is the CEO of the company, and he has got an amazing experience. Look at his background: IIT Delhi, IIT Bangalore, and AT Kearney Oracle, top-notch companies. So excellent pedigree as well as experience. Then Bhupinder Garg is the CTO, again IIT Roorkee, worked in Amazon, DE Shaw. Then third is Anurag Mittal, CFO. I am Jammu, and work with companies like Body Cupid, Ace Vector, 197 Communication, Nokia, and so on. So very strong leadership as well. Now if you look at the financials, company is into your SaaS-based model. So you need to understand that once the top line of the company grows, its bottom line grows at much faster rate because they have already done the cost. So the cost of the company would not increase in relation with your revenue. And this is the model of SaaS-based company. Once they acquire scale, their profitability grows at much faster rate because of the operating leverage that comes into play. Just remember, we discussed Traxon. Similarly, Traxon is also into that model where once the revenue would grow, their operating leverage would kick in. Although Traxon is not doing well for a long time, but that's because the US market investment has not come into the private market of India. Eventually, when that will happen, I'm still bullish that once that would happen, Traxon would do well. So moving on, you can see operating margin was actually in loss. Again, that was the COVID period. But look at this, it was at 9%, 7%, and now it is at 14%. Again, it is a very relatively new company, so you need to spend some time to gain confidence and conviction. But I think that it is looking quite promising. Look at the growth in sales from 26 crore all the way to 104 crore in just 3-4 years. So 3 times, 4 times growth in revenue in 3-4 years. Again, profit, you can't really look at it much because again, like I said, once the business would continue to grow, operating leverage would kick in, and then its operating profit and net profit would expand at a much faster rate. And that is the reason today you can't look at its PE ratio. Today it is showing a PE of 166, but that is not how you should look about it. Market cap is 2,100 crore. ROC is very high, 27%. ROE is again very high, 21%. Again, virtually debt-free company. Company is generating cash from operation, which is a very good thing. Then if you look at, so if you can't look at P ratio, what should you look? You can look at price to sale, which is 20.9. In my opinion, no matter how fast the growth is, this price to sale is certainly on the higher side. Also, EV to EBITDA at 108 is also on the higher side. But again, you can't look at EV to EBITDA because once the operating leverage would kick in, this would fall. So for now, for such kind of high growth companies, one of the reference point is price to sale, which is quite high at 20.9. Another reference point is the IPO price. I'll come to that. Just to give you a fair idea about the growth prospect, this is what they mentioned, that e-commerce business is expected to grow at 23% CAGR between 23 to 27. And e-commerce shipment business is expected to grow at 21% CAGR between 24 to 28. And Unicommerce has processed 20 to 25% of India's e-commerce dropship volume during 2023. So business size is immense and the growth is also immense, and Unicommerce has got a very major portion of 20 to 25% of this e-commerce dropship business. If we just look at the valuation, like I said, at P of 166, it obviously looks high, but also the price to sale is also at 20 point high, which is looking on the higher side. But you need to understand that it's a fast growing company. Having said this, what is the right PE or what is the right price you should pay for this company? So in my opinion, one of the reference points should be their IPO price. So during August, which is recently a couple of months ago, a company launched its IPO at a share price of 108. But then the problem is, since we are in a huge bull rally, share got listed at 118% premium. So basically on the listing day itself, the stock got doubled because of the hype for the company. And that's where I'm not comfortable paying a price to sale of 20 because the stock has already doubled. I'm tracking this company closely. Maybe if it reaches to levels of 110, 20, 30, near their IPO price, I'll consider adding it. But for now, I don't want to just buy this hype. This is certainly a very promising company, but I feel after this more than 100% jump post IPO, the valuation of the company is not looking comfortable. So if I just quickly summarize, these are the three companies that I'm tracking closely. One is Olitac, market cap 800 crore, P is 38. Management has given 20 to 25% growth guidance of organic growth. On top of that, inorganic growth would be additional. Second is Ceinsys, market cap is 1150 crore, P is around 30. Growth guidance is 20 to 30%. So you have to track their growth. If they can achieve their growth, they can certainly reward the investor. If they don't achieve their growth, it can be detrimental to their share price. And third one is Unicommerce, market cap is 2,150 crore. Again, P can't be looked at it, but price to sale is also on the higher side. Management has not given any explicit commentary on the guidance, but overall this space is also looking quite promising. Now, I don't want to stress this video further. You tell me in the comment, out of these three companies, which is the most promising one as per you, and which is the company you want me to do deep dive, where we'll discuss their risk, their growth and everything. So this is it for this video. I'll see you next video. Till then, take care.